Welcome to the 12th lecture in Unit 2 of the Ethan Trades Mentorship. In this lecture, you will be learning the second PD array, order blocks. An order block represents a price range where smart money engage in buying or selling against retail trends, capitalizing on liquidity provided by the majority of uninformed traders. When looking for an order block on a chart, there are three different ways to look for order blocks. And once the order block is identified, we pay attention to the opening price of the order block, expecting price to displace away once price touches it. This is called a change in the state of delivery, also referred to CISD. The first method to spot an order block is to use the consecutive series of candles that close beyond a previous swing point, or if you watched Unit 2C, then a liquidity pool. The order block is then activated once the first candle within the series is engulfed. And engulfed meaning that the opening price of the first candle within the series of candles is closed beyond. One thing to note is that whenever you have a bullish order block, it will be down closed candles. And whenever you have a bearish order block, it will be up closed candles. And so in this diagram here, the first method to spot order blocks is you have a previous liquidity pool, or in this case, it's sell side liquidity. You will learn this in Unit 2C. For now, you can just refer to previous swing points, where this candle right here is the first one to close below this. And so you refer to this as the first candle in the series. If there's two more down close candles after this, then you would even use those ones as well. So you use all the candles in the series. So in this case, there's only two candles. So this down close candle, this first one that closes beyond this previous swing point, and then this next candle that is consecutive with this one. So down candle, down candle. If there was down candle, up candle, down candle, then you only refer to whatever is consecutive. So once again, the down candle, down candle. If there's an up candle, that's just where it stops, and you only refer to these first two. And so by looking at these series of candles, you're now paying attention to the opening price of the order block. And so the opening price would be the first candle within the series opening price. And so once you have a candle closure above that, so that would be this close candle right here. Once you have that candle closure above the opening price of the order block, this order block has now been activated, and you look for price to trade into the opening price. And from there, you want to see a strong reaction away from that. Another way you can use order blocks, same as any PD array, is referring to the midpoint of it. But generally, you want to see the opening price being the sensitive area. Vice versa, here we have a bearish order block. And once again, bearish order blocks are going to be up close candles, right? And so here you have previous swing highs, or once you watch 2C, that would be your buy side liquidity. This candle right here is the one that closes above these previous swing highs or above the buy side liquidity. And so that's the first candle within the series of up close candles, right? Up close candles beyond a liquidity pool. And so that's what it means. And so exact same thing as the bearish or the bullish order block, but now you're just referring to the opening price of this bullish candle, right? And once that's it, engulfed by this candle right here, which means this down candle closes below the opening price of this first candle within the series, activating the order block. We now want to pay attention to the opening price of this first candle within the series of up close candles beyond a liquidity pool. We want to see price trade into it, that being a sensitive area, and price displaces away from it. And so once again, you can also refer to the midpoint of any PD array. If this opening price is not respected, then you can wait until price trades back into the midpoint, see if it's reactive to that. The second method to spot an order block is to use the lowest down close or highest up close candle after a previous swing point has been traded through. Or once again, if you've watched 2C, then a liquidity pool. The order block is then activated once the lowest down close or highest up close candle is engulfed. And so in this diagram, what makes this different is in the first example, we would have used these consecutive candles together. However, in this one, we're just going to be using the lowest down close candle or the highest up close candle. And so once the opening price of that specific down close candle is engulfed, meaning that this next up close candle or the next few up close candles close above the opening price of this down close candle right here, then you would look for that to be the activation of an order block. You pay attention to the opening price once again, and once we trade back into that, you want to see sensitive price action, meaning we displace away from that opening price, and that would be your change in state delivery. And so in this example specifically, you could also use the series of candles, but it's just a different method of spotting these order blocks. Vice versa, here is the highest up close candle after a liquidity raid, right? And this is engulfed by this down close candle that comes right after it. Once it opens and closes below this candle open, that would be the activation of order block. You're paying attention to the opening price of this order block once again. As the change in state delivery, you want to see price displace away from that. And once again, just with any PD array, you can also refer to the midpoint of the PD array to see if it's being respected or not. So a question I get a lot is, when do I use each method of spotting order blocks? And the answer to this is to pay attention to what the following candles do after an order block is formed. So on the left side, I've included method 1, and on the right side, I've included method 2. Despite this extremely similar price action in these diagrams, why did I decide to use method 1 on the left and method 2 on the right? It's because of the next candle or candles that follow the order block. On the left side, you can see that price pushes higher, engulfing all of the candles required to activate a method 1 order block. Whereas on the right side, you can see that price fails to activate a method 1 order block and only engulfs the lowest candle first, creating the method 2 order block. And so just to make it a little clearer, we can see that this is the same schematic as the one we had prior to this, right? Except the only difference now is that this next candle, we want to pay attention, what is price immediately doing, right? And so in this case, these down close candles, we're paying attention to the up close candle that comes after, and this one right here displaces higher, engulfing both of these candles, activating a method 1 order block. And so that's when I would refer to the method 1. Whereas in the second schematic here, price fails to displace higher to engulf the second one until the second candle. So I like to pay attention to what is price immediately telling me right now. And so if it fails to do that, then I'll just use method 1 and then refer to this opening price. Of course, because you have the second candle closing above the opening price of this first down close candle in the consecutive down close candles here in this liquidity raid, you can also use method 1 here, but this is just a way I like to fine tune my tape reading. The third method to spot order blocks is quite literally use every up close candle as a bearish order block and every down close candle as a bullish order block. And I personally use this method more of a trade management tool rather than looking for entries and stuff. And so the reason I say I like to use this for more of a trade management is because I'll tend to look for it in trends. So when the market's starting to expand extremely far away, whenever we create a opposing directional candle, I look at that candle as an order block. And so I'll use it to read what price is exactly trying to do right now. So let's say I missed the order block down here. I missed the entry opportunity down here. And so right here, this order block never got revisited. It didn't get traded back into, right? And so I'll look for the next order block, which is the next down close candle. Once that's engulfed, right? Once this up close candle closes beyond the opening price of this order block, I refer to the opening price of this order block as the change in state delivery. And so I'd look for continuation higher from that specifically. Vice versa, if we're trending lower, then every up close candle, I'm paying attention to how price is reacting to them specifically. And so here, once we have this up close candle engulfed by this down close candle, I look for the change in state delivery and look for lower prices. And so that's why I love using it as a trade management tool, because it tells me when order flow is being respected or disrespected against my position. So say I entered down here, Now I'm managing my trade. Well, if this is being respected, I understand it's being respected. I'm willing to trail my stop loss, meaning I'm willing to take less profits if price goes against me at this point, because I have more conviction that price shouldn't go back to this point of price. One thing to note as well is whenever you want to use method 3, then you only look for down close candles on the buy side of the curve, and you look for up close candles on the sell side of the curve. And so these candles should act as roadblocks for price, and it should most likely respect them if it's truly bullish or bearish. And so here's an example of me marking out every single method and what I would be looking at in price. And so keep in mind, whenever I do these examples, I am only annotating the ones that work, because the ones that haven't been trading back into the ones that don't work is because price is referring to other PD arrays. And by the end of this specific section of this unit, then we will be able to go over all of tape reading, how we can incorporate everything together to solve the puzzle, right? And so here, down here, you have this method 1, method 2 order block. And so the reason there's a method 1, method 2, I put both could be there because this is the candle that closes beyond liquidity. And so this technically is a method 1, but it's also a method 2 because it's the lowest down close candle. And this dotted line means that there was previous swing lows here. And so once that was activated by this second up close candle right here, right, it closes above that candle, then we can refer to either the midpoint of it or the opening price of this order block, right? And it starts trading higher. And so as it trades higher, I'm looking for any potential down close candles that get engulfed and activated. And so here we actually have that occur over here where this one is disrespected. It's going for an internal range liquidity, which once again, you'll learn that for twos in unit 2C. But here it takes out this liquidity, this sell side liquidity under this low, this swing low right here, and creates a new order block right here, right? And so this new order block is created once the up close candle right here engulfs the opening price of this down close candle, right? Because these down close candles are the ones that are responsible for taking out this liquidity. And so once that occurs, once we activate this order block, this one is a method 3 order block because this isn't necessarily the lowest down close candle, or it isn't the one that closes beyond liquidity, but rather it's just, you know, down close candles that we're referring to that get engulfed. And so we can now pay attention once that's activated. How is price respecting the midpoint of that? And how is price respecting the opening price of that for the change in state delivery? And so here you can see price trades right into the opening price and starts expanding higher. And so that's your change in state delivery. Moving on, we have the next order block that gets formed under these equal lows right here, these previous swing lows, which would equate to sell side liquidity once again. Once this candle closes here and gets activated by this third up close candle right here, we can start looking for method 1 or method 2 order block because now we are taking out that liquidity, right? And so continuing on, here we have the shift in market structure essentially, or the change in sentiment, where we go from the buy side of the curve to the sell side of the curve. And you'll see that here is the highest up close candle within this series of up close candles. So here you could use the series of up close candles. However, because we traded so far away from it and we didn't get that displacement lower just activating all of them, I decided to use the highest one. And it just made the most sense because remember, which method to use is directly reliant on what is the immediate price action after printing is telling you. And so in this case, this highest up close candle after this liquidity raid gets engulfed by this one candle. I'm immediately looking at this highest up close candle as an activation of an order block. So this is the method 2 order block. And so referring to that opening price of this order block once again, we want to see how price is reacting to it. Also the midpoint of that order block, see how price is reacting to it. And we can see that it's reacting bearishly. And so once it reacts bearishly, it starts trading lower, and we can continue looking for order blocks to, you know, manage our position. So here is one random up close candle here that we can just refer to as an order block once it's engulfed once again, right? So here we have this method 3 order block because it's not taking out any sort of liquidity. We're just using any up close candle in this scenario because we're on the sell side of the curve, using any up close candle to look for that order block. Once it's engulfed by the second down close candle right here, we refer to the order block, and you can see that it trades right into it and displaces lower. In this case, there was no change in state delivery being respected here, but this was still respecting this order block, and so you can refer to that. That's all for this lecture, and be sure to study this in your own charts. And once again, take it with a grain of salt, each PD array by itself, because you're going to need to understand all the PD arrays for them to actually come together and build that puzzle that you're looking to solve. As always, the homework and quiz for this lecture will be posted in the description below. Don't cheat yourself of this learning opportunity. Study and do the work honestly. I promise your hard work will be rewarded. Your assignment for this lecture is to go into your charts and try to spot order blocks and how price reacts to the change in state delivery levels, how price reacts to the 50% levels of them, how price reacts to the candle body of it alone, or maybe just the wicks of it alone. So see you in the next one, and as always, have a great day.